Now we get to go into one of my favorite segments, which is looking at the EIA data and trying to look at what is demand saying, what are we thinking for gasoline, diesel, jet fuel. So before we kick this one off, again, please like, share, subscribe. Your support is appreciated. And again, if you have any questions or want to comment on things that you heard or you want some clarifications, always happy to go through it a bit more detail in the comment section. But just kicking this one off, when we look at, again, this is why we always talk about the averages, because averages are so important when you're looking at lumpy data. And again, as I've said to clients and to others that ask questions about this is one data point. So the EIA data is good, but again, it's nice because it's very in depth. It's free, which is obviously a very nice thing. But again, it's just one data point. It's something that's weekly, so there can be some errors in it. There can be some lumpiness in it. So we're always looking at the averages, looking at the trend, and what are some other data points that we can use, which is why we always talk about high frequency, daily activity, those different components, which again, we covered in the Econ Show Part 1, when we were talking about the new OPEC information. So here you can see that we did have an increase of about 14.264 million barrels a day of demand when we start looking at, obviously motor, gasoline, jet, disti, and resid. And right now, again, we're kind of maintaining that back and forth, that up and down, which is what we've been saying, that the average is just going to go sideways because we are going to see a step down in the demand numbers as we look out to gasoline. And then more importantly, as we start looking into middle distillate, as some of that demand walks off. Jet fuel, same thing. Again, some of this lumpiness is just going to come through the system, which is why we don't think there's going to be too much of a drop based on the lows that we had over the last 3 weeks. It was just going to keep us within a fairly firm level. But if you look at it against 2017, 2018, 2019, we're still just well below where we have been in previous years, which is why we remain, on an overarching level concerned about total oil demand as we not only head through Q4, but then into 2021. As we talked about in the Econ Show Part 1, OPEC is reducing demand closer to us. The IEA just came out, reduced demand closer to us. Again, coming down as they continue to start to price in what we thought was going to happen, which was additional lockdowns as cases continue to rise, and we saw some of that softness in that daily activity, high frequency data points. This is one of the positive ones, and it is one to look at. Is again, disti had a big draw of about 5.35 million barrels. And you can see it was pretty much across the board that there was some big draws. Pad 1, Pad 2, Pad 3, obviously the biggest. And there's a certain amount of seasonality that's attached to that in terms of just especially Pad 1, if you look at the Northeast, moving distillate and really heating oil into the system, priming that pump. And as we did get a fairly cold spell that was captured by this, and then things really warmed up. If we look at where we were on Halloween on October 31st and where we were this past week, where it was essentially mid 30s to 70s. So this is always going to kind of be that movement. And the other key piece, which we'll talk about, is obviously trucking. Trucking remains robust. We're coming into the end of some of this peak moves in rail, which we'll talk about in a bit more detail. And then the other side of the equation is production on the refiner side remains reduced. So here you can see that the yield was walked back a little bit. Again, kind of holding steady, trying to get this distillate closer to that as we look at this on a 30-year chart level. And you can see that distillate production is still about 803,000 barrels a day off of last year and about 747,000 off of the 5-year average. So again, moving closer to that level. And Pad 3, we should start to see a little bit of a walk up again as we get into that 80% and we start to get a little bit more refinery utilization rates. But again, just based on timing, just based on where we are in the seasonality, we'll continue to see draws. The question is going to be just what is the steepness of it? And it's something where we'll see draws. It's just we don't think they'll be as steep as it was, just because we did have some residual from the hurricane. But when we start looking at demand, this is looking at that 30-year average. One of the views that we've had is that we're going to hold pretty close to this average. We thought we were going to get a little bit of a step down. Instead, we had a nice step up. And it's one where again, coming to the lumpiness, it just means that this week into next week, we're going to start to see some of that movement lower. And we think that we will take out that low there. But again, not coming too much further below that, just because refiners are avoiding some of this. We're recapturing some of that kerosene, because as we've talked about previously, we had two key components that have helped the distillate pool in general. One was recracking, which is when you take distillate, whether it be middle and or heavy, and then recrack it, and starting to recover kerosene, because kerosene can be put into, and kerosene is the starting point for jet fuel. Kerosene can be put back into the distillate pool fairly easily. And now when you had the jet fuel the jet fuel being recovered and kerosene being recovered, that also helped draw down some of the distillate pool. So these are things that are starting to normalize as we go through the remainder of the year. Now, when we start taking this to the next level, as we keep talking about with trucking. So as you know, our confidence range was at 95 to 105. Here you can see that we're at 108. There was a nice little pop that we saw. And when you look at the data points below, you can see that on a truck availability level, we're fairly flat. On a load availability level, fairly flat versus where we are on historics. So again, it's just the index is just going to come down to some of those moves. We think we'll move back within that confidence range, trying to look at this and trying to gauge where we're going to go. These data points, kind of show us that we're fairly, we're right in kind of where we think we are, especially given where we sit in terms of availability. And it's just, we'll probably overshoot to the upside, maybe overshoot to the downside 1 or 2 weeks. But through the remainder of the year, there's nothing to tell us that we're not going to stay in this elevated range right at the peak. When we start looking at pricing, you see refrigerated trucking and specialized trucking had a nice little bump, while flatbed kind of went sideways. It's going to be interesting to see when we start talking about COVID and the vaccines having to travel at such low degrees Celsius, which is about negative 70 degrees Celsius. What is that going to mean? Because most of these trucks can't handle that kind of cold, so they're going to have to be in their own containers. But again, it's just coming to cost. But one of the benefits when we're looking at rates, the rates are being supported by high demand, but they're not reaching levels that we saw in 2018, just because diesel prices remain fairly low in comparison to the 2018 levels when we saw those spikes. When we're looking at rail traffic, some things pared back a little bit. The one thing that we talked about was total carloads. We thought was going to walk back. They did. Total intermodal units walked back a little bit, but it still remained fairly robust. So just kind of breaking this apart into pieces. So when we're looking at this, one of the bigger components that we've been saying is that metallics, motor, petrol, non-metallic was going to continue to disappoint versus 2019, where grains and farm products are going to continue to be robust. And now that we're coming into the end of the harvest, and for some people it's already ended, for others it's going to end in the next few days, the grains will remain strong versus 2019. They'll start to pare back a little bit, but again, still remain robust. So even though carloads were down 8.4% versus 19, intermodal units were up 10.3%, which means total traffic was up about 1.3%. When we look at a year to date, we're still down year to date, but again, we've had some support. Our view now as we head into the rest of November and into December is that grains are going to start to slow down, still outpace 2019. We're not saying that we're going to fall negative. It just the outpace won't be as large. Chemicals is going to be more timing in terms of where things are moving. The biggest headwinds are going to be kind of those core, and as we have always talked about, the real economy in terms of some of these cyclicals, some of these companies and raw materials and semi-finished goods that are going to continue to get a little bit weaker, which is going to pull down some of the intermodal units. So we had a nice spike. When we look at imports and we look at things happening at the coast, those remain at seasonal lows, and even when we look back over the last few years, remain at a low, even going back that far. So again, those slowdowns are just gonna be a headwind for total intermodals as we go through the remainder of the year. But even though train loads won't see the same type, it doesn't speak that to trucking. Trucking will continue to be fairly robust but rail traffic will start to pare back. Intermodal right now will probably still be on a growth level versus 19, but it's just the total traffic will start to walk back as we go through this week into next week, and then again as we progress through the remainder of the year. Gasoline stocks had a nice draw of about 2.3 million. It was really driven based purely on PADD 3 when you saw the reduction of about 2.6 million barrels. Again, coming back to the hurricane, people not driving as much, but pulling down from storage. Some of the things that we've talked about or we haven't talked too much about is when we look at octane and blending components. So here you can see blending components had a draw of about 1.8 million barrels. When we look at the year-over-year and 5-year average, there was some normalcy in this, but it's just nice to see some of this flow through. And when we look at the overall storage, you can see that we're still near that high over the last 30 years. We're still at the top of the cloud, but again, nice little pullback just based on where we think demand is going and storage is going. We think that this is going to slow down just because a lot of the volume coming out of storage was really backfilling the system, and now we're seeing that slowdown on the consumer side. So as everything is reduced and the supply chain catches up, then we're going to start to see these slowdowns. So we would expect to see not only demand decline, but we will see some of these draws slow down as well. As we've talked about, imports are going to slow as we got to the second week of November, and here we are. When we look at flow coming from the Europe, it's slowing overall just because the arbitrage isn't there. We continue to see problems when we look at road usage in total, and that's something that we'll talk about, like as some of the new numbers coming out in terms of weekly indicators of road use in Europe fell again last week, slumping to the lowest level since June. Again, nothing crazy to assume, just given where we sit with lockdowns. That's not a surprise, and we'll go through a bit more detail. Now, when we talk about motor gasoline, again, nice little pop. But when we look out and we start to project going forward, we think we're going to fall back to, I wouldn't say too far past the low that we saw last week, but it'll be something a little bit below that. Again, as we see some of this lumpiness as the hurricane passes, as some of these guys had to refill, the election cycle pulled a decent amount of gasoline into the system, again, moving some of that through the system. And now we're starting to normalize on a go-forward basis. This is looking at activity. Again, as we've been talking about, activity continues to trend lower. Grocery stores, retail. Parks had a nice little bounce, which if you were able to experience the weather, it's not surprising to see a little bit of a recovery there. But the trends remain depressed and moving lower as we go through the remainder of the year, especially as it gets colder and lockdowns or the potential for lockdowns are starting to increase. Now, when we look at Apple data, here you can see that we had another reduction versus week over week. The U.S. was still up 6% versus baseline, but it was down, obviously, as you can see from the peaks. Germany moved lower again by 13, now down 13%. UK down to 22%. Italy, again, continuing to shift lower. As we've said before, we're not going to get back to those March, April, May levels, but we will get, I think, take out the lows that we saw in June as the lockdowns intensify, as things start to increase, because the UK, it became official middle of last week. And now France is saying that they're going to keep things in place for another 2 weeks. And it's just a matter of kind of slowing down some of the spread that we've seen. And we'll start to look at some of those numbers in a different chart. Here's some of the bigger components. So our expectation last week was that we were going to get an increase in demand. And the reason why we thought we were going to get an increase in demand was because of the election, people driving to the election. And then it was supposed to be nice and warm and people were going to do more. So the update on gasoline demand. So according to Pay with Gas Buddy, So again, looking Wednesday, gasoline demand was up 2.6% from the prior Wednesday. Tuesday was down 7.1% from election day, while Monday was down 5.5%. So when we're looking at this and we start to normalize, you can see on the blue line, we had a nice little spike, a Sunday, Monday, Tuesday, and then things really dropped off through Wednesday, Thursday, Friday, Saturday. So when we look at the composite of last week, week over week, Gas Buddy data had us down about 1.5% from the previous week. Again, kind of moving down, which was the lowest since the week of October 20th. Now, that's what's happened here. So here you can see that there was a spike on Monday, there was a spike on Tuesday, but now this week, as we start to project forward, is down, versus Tuesday, we're down 7.1%, again, taking away essentially all of that move. And Monday, same thing. So again, we continue to see those slowdowns in terms of gasoline demand. And when we start talking about why, we have to think about where we're seeing. So the U.S. continues to have an increase in cases, and they're really being driven by the Midwest. And when we think about the Midwest, that is the biggest consumer of miles driven, of consumption of oil, which is we're seeing that get walked back. And that's why when we look at the case counts, and we went really in depth in part one of the econ show, so we're not going to rehash it too much. But India is going to be the one to watch when we start talking about Asia and what's happening in the Asian arena, because right now the net change has stopped. So we had things declining, and now the net change is kind of flatlined, which is a problem because it is festival season. And then what is going to happen as they come out of festival season? Will we see an increase in cases? And that's going to be the chart, I think, to watch the most when we start to think about Asian oil demand overall. This is just an interesting chart. So I thought it was kind of cool to look at, well, how like the RNA vaccines, they have to be kept at that negative 70 degrees Celsius. And this kind of puts it into context as how cold is that? Well, the coldest recording on Earth versus frozen meat. And it comes to, how are we going to move this through the system? What are the logistics of getting this from point A to point B and then from B to C, just because it has to stay this cold, and just moving things through. And obviously we're going to have to utilize a lot of liquid nitrogen and dry ice to get this into the right hands to get everyone inoculated. Now, when we look at slumping overall, so this is just taking the average because it's easier to see those slowdowns. We can go through different pieces. Realistically, everything is down anywhere between 35 and 40%. So here, when you look at the numbers right now, we're down about 37%. And you can see that coming to April, May, we're not going to get back to those levels, but we will get back to, I think, some of the June lows, especially as weather changes and people try to avoid some of this undue exposure. So this is something to watch. Again, when in part 3, we're going to go through what does storage look like, what do some of the numbers look like, and what are we going to see in terms of additional flow coming out. So then when we turn to jet fuel, we have to look at what's happening with jet, how are things situated. And here you can see that we have another draw of about 280,000 barrels a day, 280,000 barrels. And you can see we're below the year over year, we're below the 5-year. And again, it's just, kerosene, jet fuel has not been demanded overall with some of the data that we'll talk about in a minute. But here you have the big spike. And now we thought the spike was going to come a little bit later. And by later, I mean probably this week. Instead, it came here, and when you think about airports and airlines, they need to prep for what they know is going to come, which is always going to be a spike in activity as we go into Thanksgiving. And this is that pull through. Now, this is not something that we think is going to continue. It's something that we think is going to, pull back. But again, it will remain supported because just because we got this one move doesn't mean everybody did it at the same time. There will be some follow through. And then once, if Thanksgiving is as big as it has been in the past, or what they're expecting to be a little bit reduced, then obviously, we'll start to see some of this normalize over the next few weeks. And when we look at just U.S. passengers overall, you can see that overall passengers kind of are sitting within our view of, let's call it that 550 to 850 level. We had that little spike to about 1 million, but again, we quickly dropped off. And we're going to average in the normal kind of level of those, that 550, 850, and just in terms of where things are going, because Corporate travel still remains low. Obviously, everything is happening in Europe, which is reducing activity. And we saw a walk back in terms of activity in the U.S. There will be an increase. That's just the nature of where we're going to go for Thanksgiving. Maybe instead of people, there could be some more driving, but people will be taking flights, at least in our opinion, as we go into Thanksgiving. Obviously not as much as last year, but still, there'll still be some increase in activity. Now, a bigger component is when we look at activity. So U.S. corporate travel remains 86% below 2019 levels, according to airlines, which just, if you think about the sheer size and how airlines make a lot of their money, it is from corporate travel. It's from first class, it's from business class. Coach is, making a small margin or at least breaking even, where the big benefit comes from the front of the plane. So U.S. airline holiday travel is being dispersed across more days, which on average has been about 8 is the assumption, is that instead of it being, obviously people going on, maybe Tuesday or Wednesday, now it's going to start the weekend, before that weekend, and continue as people look to extend holidays, maybe see family that they haven't seen for an extended period of time due to COVID. And this is just an interesting chart. So we did get an increase, some 370 more departures on average each day for the week starting November 4th. And this is following the declines that we've been talking about that are about 1,000. Now, even though we are getting more in the U.S., you can see that we are getting less in Europe, and that's because lockdowns have been either extended or maintained at the current levels. France came out and said they're going to keep things the same for the next 2 weeks. The U.K. increased the middle of they had their lockdown middle of last week. These are things that are starting to come out, which is why you see the UK with the biggest drop of 171, France with another drop of 111. Again, it's just because of the consistency. The U.S., we're starting to see those additions, and the additions are, again, ahead of the view of Thanksgiving travel. So here, European air traffic fell sharply, again, not surprise, over last week, dropping to 38% of 2019 levels on November 30th. And then air traffic is down by 58% year over year for November 1st to 11th, which is in line with what Eurocontrol has talked about, because we keep talking about Eurocontrol, IATA, just to give you an idea of kind of what is happening, and because this is going to continue. This is not something we think is going to stop over time. Now, to give you an idea of kind of where we think things are going, when we talk about OPENTABLE, it happened. What we thought was going to happen did happen, in the sense where we got lower lows, lower highs, and everything's kind of shifting lower as we head back into not only weather-related problems, but also new COVID cases. So again, the data has shown that most people, who are 80% of new cases, are originating from restaurants, gyms, and I believe there was one other. But it essentially comes down to close proximity of extended periods of time indoors is obviously a problem. I know, not reinventing the wheel by saying that. It's something that we've known for some time. But here you can see that it actually showing up in the data, and people are responding accordingly. And here's where we can look at OPENTABLE regional breakdowns. Australia hasn't had a local transmission. I think they're now up to day 8 without a local transmission. So here we're getting more activity. Global remains depressed. Obviously, Germany, Ireland, UK. So UK kicked off, and you can see where they kicked off. It was the 5th. And so here you can see people, made their rush to get their time. And then obviously they went into a lockdown, and the U.S. is kind of maintaining this, let's call it, 47, 42 to 58, depending on what is happening within that time frame. The U.S. was one that we think is going to continue to get a little bit worse as people start to avoid some of the exposures, especially as maybe they pull back a little bit, trying to minimize exposure as they prepare for Thanksgiving, which is, I think, an overarching theme. If you think about, okay, well, will I do less because now I know that there is a vaccine on the horizon and I don't want to get it yet? Or am I going to do less to minimize it, and am I going to do my own quarantining so that when I see my family on Thanksgiving, everybody's going to be safe? I think these are things that have to be considered as we go through at least the remainder of November. And then what happens where as people prepare for their December holiday, specifically Christmas for us, is, will you do less to mitigate against a potential exposure to your extended family? And these are things that I think are going to reflect in specifically restaurants, because we know restaurants are an area of concern. And maybe you'll spend the next month and a half not going out to eat, but just getting takeout. Wrapping it up, just because we like to look at the MTA data here, you can see that the 7-day moving average is shifting a little bit lower. Again, we're within a pretty tight confidence range. You can kind of see how since September we've been pretty flat, and there's, again, no reason to see that adjusting one way or the other. The 7-day moving average has moved a little bit lower, but not by much, by maybe about 20,000 a day, and that's something where we think that's more people avoiding their additional exposures. We'll see some of this adjust, but again, I think this is something that's going to be pretty consistent over, let's just call it, the next couple of months as we look at cities and how cities are responding. Chicago just came out talking about another lockdown due to increases in cases. Again, New York is already starting to talk about it. Teachers are told to prepare, give out their novels. Something that my wife just told me, that one of our friends was told to give the reading list for the next for the year, just in case there is a lockdown that may start, between Thanksgiving and Christmas, and then reassess in January. But again, these are things that are going to be highly impactful to inherent oil demand, specifically as we start to look at not only oil but also refined products, as we look at refined products and then go backwards. So in the next segment, we're going to look at it a bit more global, looking at not only U.S. exports, but what's happening in the grander scheme of things as we go abroad.